So what happens when the company that judges your credit score, TransUnion, suddenly gets judged pretty harshly by the market? Today, it's really not pretty. It's like a credit giant just had its own credit line cut by investors. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks. We're using our research data captured this morning, October 3rd, 2025, to dive deep into TransUnion, that's ticker TRU.
Yeah, and we really need this urgency today. This isn't just, a bad day on the market. That catastrophic 12% drop yesterday, it was triggered by something much deeper, an existential threat to their fundamental business model. It goes way beyond typical market swings.
Okay, right. Let's unpack this then.
Well, first, just the broader context. Pre-market futures are ticking up slightly, but honestly, that confidence feels paper thin right now. You've got Treasury Secretary Bessent sounding the alarm about the looming U.S. government shutdown. He's warning it could slash GDP by $15 billion for every single week it drags on.
And that shutdown risk, it isn't just market nervousness, is it? It directly impacts TransUnion. Fewer big financial transactions mean fewer loans, fewer mortgages getting processed. That hits their revenue right when things are already shaky.
Precisely. And that leads us to the siege, which is the real story here. Here's where it gets really interesting. Their core revenue stream, the really profitable part, is under direct, immediate threat. Why? Because Fair Isaac FICO, the company behind the score itself, is moving to bypass the credit bureaus like TransUnion entirely.
Okay, tell us more about that. How big of a threat is this, really?
It's huge. FICO is apparently licensing its mortgage scores directly to lenders now, and get this, at a staggering 50% discount.
50%?
Yeah. I mean, mortgage scoring, that's often the single most profitable, high-volume business for bureaus like TRU. FICO is essentially trying to cut out the middleman and take half the potential profit margin on the industry standard product. You could argue this is, irreparable structural damage to the old way of doing business.
And yet you wouldn't necessarily know it from TRU's public statements.
That's what's so fascinating, right? Well, while this operational bombshell is dropping, what's TRU focused on? Co-publishing a white paper about brand marketing.
Brand marketing? Seriously?
Seriously, it's almost the definition of rearranging deck chairs on the Titanic. So you have to ask, are they genuinely tone deaf, or is this just, corporate denial kicking in?
And it looks like that disconnect extends to Wall Street analysts too. They're still overwhelmingly bullish. 77% rate the stock a buy or strong buy. It suggests they think TRU can pivot. Or maybe that this FICO move isn't as bad as it sounds. Are we maybe being too harsh here?
Well, look, if you want proof of that disconnect, just look at the value. Our research focuses heavily on free cash flow, FCF, right? Because in a service business like this, reliable cash is paramount. Based on that metric, our calculated fair value estimate for TRU is only $69.46.
$69.46.
Right. So clearly the institutional money, the big money moving the stock, doesn't seem to care much about those analyst ratings right now.
Well, the charts certainly seem to reflect that institutional fear.
Oh, absolutely. The charts are, they're brutal and pretty unambiguous. The price has just sliced clean through both the short-term and the long-term trend lines. And it did it on huge selling volume. That confirms a massive flow of capital is rushing out of the stock. No question.
You'd think sentiment would be completely in the gutter then, but there is maybe a tiny flick of hope in the options market. The put-to-call ratio is 0.93. That shows slightly more bullish bets overall. Some people are even targeting optimistic $95 call options.
Right, there are some optimists out there.
But countering that, you've got significant short interest. It's standing at 4.49% of the float. That suggests the bears think the pain is, just beginning.
And if we tie this all together, momentum has absolutely collapsed, with significant force. But there's one key technical gauge that's gone extremely low. The Relative Strength Index, the RSI, has plunged below 30. That technically pushes the stock into oversold territory.
Okay.
And that really is the only potential technical reason you might see a short-term relief rally. It might attract some bottom fishers looking for a quick bounce.
So bringing it all together, what does this mean? Our verdict, based on everything, it has to remain a decisive bearish outlook, primarily because of that, what you call irreparable fundamental damage from FICO's move.
Exactly. And for you, the listener, the battleground levels are pretty clear now. The bears remain firmly in control as long as the price stays below that breakdown area of, say, $73 or $50, $60, $74. Below that, they're likely targeting the major support down near $65.
And the level that would change that bearish view.
The invalidation level where the bears might have to retreat would be a sustained move back above $75.
It's just a stark reminder, isn't it? When you're in the business of judging others financially, the market is always ready to judge you right back. And sometimes your judge turns out to be your biggest vendor.
Well said.
That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.